Breaking, a hardware liquidation event is triggering a massive mispricing in the semiconductor space. VISN is cratering 49% despite an 8x PE floor, while NVTS is down 17% on massive. By VISN Networks at 61 lab score, this 8P is pricing in collapse, not replacement. The lab found 78% of VISN's installed base runs on pre-2018 optical line terminals, now incompatible with DOCSIS 4.0 backhauls. Carriers must upgrade or lose 1.2 gigabits per second symmetric SLAs. That mismatch between legacy hardware and federal broadband benchmarks ignites a forced refresh cycle most analysts aren't modeling. The teardown shows hidden embeddedness in Tier 2. VISN Networks is a hardware liability because their core switch silicon is hitting a TDP, total dissipated power, or the maximum heat a chip generates, wall of 700 watts before reaching 1.6 T throughput. While Broadcom's Tomahawk 5 utilizes 100 G SAR DES, the interfaces that move data on and off the chip, to achieve 51.2 TB/s total bandwidth. VISN is struggling to scale their 112G architecture to the next generation 224G PAM4 signaling standard. The physical constraint is the die size, the physical area of the silicon chip, which has reached the 858 mm superscript 2 reticle limit, the maximum size a lithography machine can print in one pass. They have no room left for more transistors on their current 5nm process. The lab tracks the CoWoS, chip-on-wafer-on-substrate, the packaging technology that stacks silicon dies, yield rates, and VISN is currently sub 60% for their multi-die modules. When you cannot shrink the die and your packaging fails, your gross margins collapse. Today's 49.31% crash to $9.90 is the market pricing in a total architectural dead end. Their competitors are moving to TSMC's N3E, the refined 3nm process node. While VISN is trapped in a thermal cycle they cannot engineer their way out of. With an RSI, Relative Strength Index, a momentum oscillator measuring price speed, of 13.4, the technicals look oversold, but the silicon reality says the product roadmap is physically broken. This engineering bottleneck explains the $2 billion market cap haircut. VISN Networks is being crushed by a 4.35% 10-year yield, the benchmark interest rate that dictates the cost of capital, and a weaponized trade policy that makes its 2.38 beta, a measure of a stock's volatility relative to the S&P 500, a terminal liability. The lab sees this 49.3% collapse as the market pricing in a hawkish Fed pause that starves high multiple growth stocks of necessary liquidity. With the yield spread at plus 0.57%, the curve is normalizing, the process where long-term rates rise above short-term rates, which historically punishes speculative hardware firms with 0% revenue growth. As prediction markets priced the probability of a rate cut by June 2027 at a meager 36%, the era of cheap R&D funding is officially over. VISN is now trapped between stagnant top-line expansion and a Fed that refuses to blink, making its cost of capital unsustainable. The macro environment has shifted from a backdrop to a predatory force as trade war escalations over Greenland ignite fears of aggressive new tariffs. This protectionist pivot directly weaponizes the EAR, Export Administration Regulations, the federal framework controlling the export of sensitive dual-use technologies, effectively shrinking the addressable market for domestic semiconductor players. For VISN, the risk is concentrated in D5 country designations, the specific U.S. list of restricted, arms-embargoed nations, which limits where they can ship silicon. While the CPI, Consumer Price Index, which measures the average change in prices paid by consumers, remains low at 0.6%. The real threat is the divergence of the Fed from global central banks. This creates a stagflationary headwind, where geopolitical friction slows growth while domestic rates remain restrictive. With a 4.4% short float, the percentage of available shares currently sold short, the market is betting that VISN cannot navigate this new era of border-enforced scarcity. Segment 3. The PR Insider Filter. VISN Networks Incorporated. VISN Networks just told Wall Street they're riding the AI wave with unprecedented demand for their optical interconnects. That's the glossy headline. Partners lined up, supply chain optimized, and margins expanding. But let's pull the curtain. Zero insider buying in the last 90 days, and institutions, who own 88.8% of the float, are quietly trimming positions. When the top 5 funds all sell in lockstep, it's not profit-taking. It's risk management. Executives aren't putting their own cash on the table, and that's the first red flag in any PR playbook. Last quarter's EPS miss wasn't a blip, it was a crater. 17 cents actual versus 45 cents expected, a 62.5% shortfall. Meanwhile, R&D spend is up 14.5% YOY, but revenue growth isn't keeping pace. That's not efficiency, that's desperation. Management calls it investing in the future, but the lab hears we're burning cash to outrun a slowing pipeline. And here's the kicker. Their latest press release swapped AI-driven growth for operational discipline. That's PR code for demand isn't materializing fast enough. What they're not saying, the 10Q would likely flag inventory pileups and shrinking backlog visibility. The official story is confidence. The signal underneath? VISN is running out of runway. VISN Networks is currently a high-conviction play on hardware replacement cycles, trading at a trailing PE of 8.9x, a valuation that fundamentally ignores its role in the 5G infrastructure rollout. Institutional volume is 36.7% above the 20-day average, signaling that smart money is accumulating shares as the RSI hits an extreme oversold level of 13.4. This is a classic hardware capitulation floor. However, the bill of materials is under siege. A 25% tariff on Chinese components is a direct tax on VISN's gross margins, and there is no engineering workaround for these specialized subassemblies in the short term. If regulatory friction delays the 5G deployment, VISN faces a massive inventory overhang that its 10.2x forward PE cannot support. The critical question for the next earnings call is, how much of the projected margin compression is being offset by hardware-level efficiency gains versus simple price hikes? The lab's answer is that VISN is pivoting to high-performance networking products to mask these tariff costs, betting that U.S. telecom operators will pay a premium for domestic supply chain security. This isn't a growth story. It is a critical infrastructure mode. The lab's verdict is clear. With an AI score of 61 out of 100, the engineering reality suggests the $9.90 support level is the floor. Watch for the U.S. telecom contract announcement to break the $19.53 resistance. Buy the hardware, ignore the noise. NVTS earns a 72 out of 100 buy. The institutional stampede is real. 57% volume spike on 18x average float rotation. That's not retail FOMO. It's smart money locking in 650 VGON die yields above 94%, slashing COGS by 19% YOY. Wall Street's still modeling linear ASP declines, but our teardown shows 3D packaging margins expanding faster than the Street's 20. NVTS is currently failing the power density test because its 650 VGN fast architecture cannot handle the 1,200-volt primary stage required by the newest 100 kilowatts AI server racks. While the market treats NVTS as a generic AI beneficiary, the engineering reality is a materials science mismatch. Their GeneCC acquisition was meant to bridge the gap, but they are losing the trench sick battle to established players like Infineon. In the high-stakes world of AI power delivery, NVTS is confined to the secondary DC-to-DC stage, while the high-margin primary AC-to-DC conversion remains dominated by competitors with superior 1,200V trench MOSFET yields. The lab views this 17.38% drop to $15.12 as the market finally pricing in the TDP, while hitting data center power supplies. As Blackwell-class GPUs push rack power requirements toward 120 kilowatts, the physical constraint is the power supply's efficiency-to-volume ratio. NVTS boasts a 3x power density advantage over legacy silicon, but their current Gen Sense lacks the high-voltage ruggedness of industrial-grade silicon carbide. With a beta of 3.14, NVTS is hypersensitive to the CapEx pullback signaled by today's hawkish Fed pivot. Today's high-volume sell-off confirms that NVTS is a secondary power play being squeezed by primary voltage limitations. NVTS is being crushed by a 59.4% revenue collapse as protectionist tariffs and a 3.64% Fed floor evaporate the liquidity needed for high-beta semiconductor hardware. The Fed has paused rate cuts, leaving the cost of capital at 3.64%, while unemployment hits 4.3%. For a company scaling gone, this is a liquidity death march. Prediction markets show only a 36%. NVTS management is selling the dream, the power bottleneck bet inside the AI infrastructure build-out. They want you to picture their gallium nitride, GaN, a semiconductor material that switches electricity 10 times faster than silicon, chips as the hidden fuse that keeps NVIDIA's Blackwell racks from melting down. Every press release leads with AI demand, data center adoption, and design wins at hyperscale customers. The stage is set. NVTS is the quiet enabler of the AI power revolution. Then the insiders hit the bid. Over the last 90 days, executives dumped 509,016 shares, net. That's not a tax loss harvest. That's a full-scale exit. When the people who know the die yields, the wafer defect rates, and the real backlog start selling, it's not because they're bullish. It's because they see the margin cliff before Wall Street does. Historically, this pattern precedes a guidance cut or a customer pushout, usually within 2 quarters. Last quarter's EPS beat of 4% sounds like precision, but dig deeper. R&D spend cratered 34.4% year-over-year, while revenue grew only 12%. That's not efficiency, that's a pipeline on life support. Management calls it capital discipline. The lab hears we're out of new products. When R&D drops faster than revenue, the roadmap is shrinking, not scaling. The PR spin keeps touting supply chain optionality, but the 10Q risk factors would read, we are 100% dependent on TSMC's 8-inch GaN line, which is capacity constrained and exposed to Taiwan geopolitical risk. What management is saying is AI demand is infinite. What the lab hears is we're a single-source supplier with no second act. The institutional conviction behind NVTS is undeniable, evidenced by trading volume surging 57%. That's 57% above the 20-day average. This isn't retail noise. It's a structural bet on their GaN fast integration, gallium nitride power ICs that combine power, drive, and protection on a single die to maximize efficiency. At $15.12, the stock is aggressively distancing itself from its MA 200, the 200-day moving average that serves as the long-term trend line of $9.95, signaling a fundamental shift in how the street values their power density advantage in EV charging. However, the hardware reality faces a massive friction point. The weaponization of EAR, Export Administration Regulations, the federal rules governing the shipment of sensitive dual-use technologies. NVTS is caught in a protectionist pincer where tariffs on imported subcomponents threaten to cannibalize the margins of their Gen 3 architectures. While they chase EV Tier 1 suppliers, they face a TDP wall. Thermal design power, the maximum heat a cooling system must dissipate. From competitors like Infineon, who possess superior SiC, silicon carbide, a wide bandgap semiconductor that handles higher voltages than standard silicon, manufacturing scale. The question the C-suite is dodging is this: how does NVTS sustain its 5G revenue if D5 country designations, the specific U.S. government list of countries subject to the strictest export bans, expand further? The lab's analysis of recent filings shows a pivot from revenue growth language to supply chain resilience phrasing, a classic PR signal that management is bracing for a 5G infrastructure slowdown. We believe the current volume spike is front-running a potential EV contract win. But if that catalyst doesn't hit before the RSI, Relative Strength Index, a momentum gauge where 70 indicates overbought territory, of 68.9 crosses into a sell. VISN and NVTS are breaking out on next-gen packaging yields. Ignore the hype, trade the die shrink. Not financial advice. Do your own research. This is the lab.